Today, I want to talk about Robinhood, ticker symbol HOOD, after its Q1 2026 earnings. And I think this was a pretty interesting quarter because on the surface, Robinhood still looks like a company with strong momentum. Revenue is growing, customers are adding more assets, gold subscribers are increasing, the margin book is growing quickly, and the company remains highly profitable. But at the same time, the quarter was not perfect. Crypto revenue fell sharply, transaction revenue came in weaker than expected. Expenses grew faster than revenue, and the stock is still trading at a valuation where the market is clearly expecting Robinhood to keep executing very well over the next several years. So the main question is not really, is Robinhood a good business? I think the business has clearly improved. The bigger question is, at around $70 per share, is the stock still attractive enough for a long-term investor? As of the latest market data, Robinhood trades at around $70.87 per share. That gives it a market cap of about $65.1 billion. The trailing EPS is about 2,040 cents, and the reported PE ratio is roughly 29.5 times. So this is no longer a cheap recovery stock. Robinhood is now being priced like a high-growth, high-margin fintech platform, and that means the bar is higher. Let's start with the quarter itself. Robinhood's total net revenue grew 15% year-over-year to $1.67 billion. Net income grew 3% year-over-year to $346 million. Diluted EPS came in at 38 cents, also up 3% year-over-year. Adjusted EBITDA grew 14% to $534 million, which means Robinhood delivered a 50% adjusted EBITDA margin. Adjusted EBITDA is basically a profitability measure that strips out items like interest, taxes, depreciation, amortization, and some other expenses. It is not the same as net income, but it gives investors a sense of the company's underlying operating profitability. And by that measure, Robinhood remains very profitable. But the earnings quality was more mixed. Transaction revenue grew only 7% year-over-year to $623 million. That is still Robinhood's largest revenue stream, but the growth was not that strong because crypto was weak. Net interest revenue was much better. It grew 24% year-over-year to $359 million. That was helped by larger interest-earning assets, especially margin loans and customer cash balances. Other revenue grew 57% to $85 million, driven mainly by Robinhood Gold subscription revenue. So the positive point here is that Robinhood is becoming more diversified. It is no longer just a stock and options trading app. It now has more revenue coming from interest income, subscriptions, lending, and other financial products. But the negative point is that trading activity still matters a lot, and when crypto slows down, the impact is still very visible. Crypto revenue fell 47% year-over-year to $134 million. Robinhood app crypto notional volume also fell 48% year-over-year to $24 billion. That is a big decline. Meanwhile, equity and options activity was much stronger. Equity notional trading volume rose 54% year-over-year to $638 billion, and options contracts traded increased 17% year-over-year to 586 million. So this was not a weak trading quarter across the board. The issue was more specifically that crypto was a major drag. And that highlights one of the key things investors need to understand about Robinhood. The business is improving, but it is still market sensitive. When retail investors are active, Robinhood benefits. When risk appetite is high, Robinhood benefits. When crypto is strong, Robinhood can generate a lot of high-margin revenue. But when those areas cool down, revenue growth can become much more uneven. Now, one of the strongest parts of the quarter was customer asset growth. Funded customers increased 6% year-over-year to 27.4 million. That is steady growth, but not explosive. The more important number is total platform assets, which grew 39% year-over-year to $307 billion. This matters because Robinhood's long-term opportunity depends less on just adding new accounts and more on getting customers to move more of their financial lives onto the platform. And on that front, the quarter looked strong. Net deposits were $17.7 billion in Q1. Over the last 12 months, net deposits were $67.8 billion. That represents a 31% growth rate relative to prior platform assets. To me, this is one of the most important bullish signals. Customers are not just using Robinhood casually, they are continuing to move money onto the platform. And if Robinhood can hold onto those assets, it creates opportunities to monetize through cash sweep, margin lending, retirement accounts, advisory products, banking, credit cards, and trading. That is the bigger thesis. Robinhood wants to become a financial super app, not just a place to trade stocks. It wants to become a broader financial ecosystem that includes brokerage, options, crypto, retirement, banking, credit cards, margin lending, prediction markets, wealth products, private market access, and international expansion. And this is where Robinhood Gold becomes very important. Gold subscribers grew 36% year over year to 4.3 million. That means around 16% of funded customers now subscribe to Gold. And according to the company's presentation, Gold subscribers have around 5 times the assets under custody of the average funded customer. They also have around 1.2 times the net deposit growth and around 3.3 times retirement adoption. So Gold is not just a small subscription product. It is basically Robinhood's way of identifying and monetizing its most valuable customers. Gold users appear to be more engaged. They hold more assets, they deposit more money, and they are more likely to use multiple Robinhood products. That makes Gold strategically important because it can help Robinhood become less dependent on pure trading activity over time. The more customers use Robinhood for retirement, banking, lending cards, and advisory, the more recurring and balance-based the business can become. And that is what makes the Robinhood story more interesting today than it was a few years ago. Earlier in its history, Robinhood was much more tied to retail trading hype. Today, the company has more monetization engines. It earns trading revenue from equities, options, crypto, futures, and event contracts. It earns net interest revenue from margin loans, customer cash, cash sweep, credit card balances, and corporate cash. It earns subscription revenue from Gold. It is building wealth products like retirement accounts and Robinhood strategies. It is expanding into banking and credit cards. And it is also building internationally and in crypto infrastructure, partly through Bitstamp and other initiatives. So the business model is becoming higher quality, but there is a difference between better business and attractive stock. And that is where valuation matters. Before getting into valuation, let's talk about profitability and the balance sheet. Robinhood had operating expenses of $656 million in Q1, up 18% year over year. That means expenses grew faster than revenue, which grew 15%. As a result, net margin declined from 36% in Q1 2025 to 32% in Q1 2026. So, while the company is still very profitable, this quarter did not show operating leverage. Operating leverage basically means revenue grows faster than expenses, allowing profits to grow faster than revenue. This quarter, the opposite happened. That is something to watch, especially because Robinhood is launching many new products and expanding internationally. The company is investing aggressively, and that can be a good thing if those investments generate future growth. But if product expansion adds cost and complexity without enough return, margins could come under pressure. Still, Robinhood's profitability remains impressive overall. Q1 adjusted EBITDA margin was 50%, and the last 12 months adjusted EBITDA margin was 56%. That is extremely strong for a fintech platform. The business is also very capital light. CapEx and capitalized software were only $18 million in Q1, compared with over $1 billion of quarterly revenue. That means Robinhood does not need massive physical infrastructure spending to grow. It has a highly scalable model. The balance sheet is also strong. Robinhood ended the quarter with about $5 billion in cash and cash equivalents. The presentation also says the company had about $5.2 billion of corporate cash, investments, and stablecoin, plus $4.9 billion in available lines of credit. That gives Robinhood a lot of flexibility. It can invest in growth, it can make acquisitions, it can absorb volatility, and it can repurchase shares. On buybacks, Robinhood repurchased $250 million of stock in Q1 at around $81 per share. Since Q3 2024, it has repurchased 25 million shares for $1.2 billion at an average price of around $46. The company also refreshed its buyback authorization to $1.5 billion. This is a positive shift. Robinhood is no longer just issuing stock and diluting shareholders. It is now using cash flow to offset dilution. The presentation says fully diluted shares decreased around 1% year over year, while diluted shares were roughly flat. That matters because stock-based compensation can be a major issue for high-growth fintech and tech companies. If buybacks can at least offset that dilution, shareholders are better protected. Now, let's talk about some of the key product and strategic developments. Robinhood highlighted several new initiatives, including Cortex AI tools, Robinhood Social Beta, banking, Gold Card, Robinhood strategies, trust and custodial accounts, Robinhood Ventures Fund I, Robinhood Chain Testnet, and international expansion. That is a lot, and this is both the strength and the risk of the Robinhood story. On one hand, the company is moving quickly, product velocity is high, management is clearly trying to build Robinhood into a broader platform. On the other hand, when a company launches too many things at once, investors need to ask whether these products will actually become meaningful revenue drivers or whether they simply add operational and regulatory complexity. The investment case increasingly depends on whether Robinhood can turn these products into real monetization, higher retention, and better long-term returns on capital. There were also two specific developments worth mentioning. First, the US Treasury announced that Robinhood will serve as broker and sole initial trustee for Trump accounts, with BNY also involved as financial agent. Robinhood says it will build and run the standalone app, provide support, educational content, and custody account assets. Financially, management now expects an additional $100 million of 2026 spending to support Trump accounts. But the work is contracted on a cost-plus basis with a small margin, so revenue should exceed costs. In simple terms, this may not be a huge near-term profit driver, but it could be strategically useful because it puts Robinhood in front of younger future investors. At the same time, it also creates political, operational, and reputational exposure. Second, Robinhood received in-principle approval from the Monetary Authority of Singapore to offer brokerage services. That supports the international expansion thesis. The US opportunity is already large, but if Robinhood can expand successfully into international markets, the growth runway becomes larger. The risk is that financial services are heavily regulated, competition is local, and market structure differs by country, so international expansion is not automatically easy. Now, let's move into the moat and competitive position. Robinhood does not have a traditional hard moat like patents or exclusive data. Its moat is more about brand, user experience, customer acquisition, scale, and product ecosystem. Robinhood has strong brand recognition, especially among younger investors. Its app is easy to use, it has a consumer-style product experience, and as users adopt more products like gold, retirement, banking, cards, and advisory, Robinhood has a chance to increase wallet share. Wallet share simply means the percentage of a customer's financial assets or financial activity that Robinhood captures. If customers only use Robinhood for occasional stock trades, the opportunity is limited. But if they use Robinhood for investing, retirement, cash, credit cards, margin, crypto, and banking, then the economics become much more attractive. That is the bull case. The bear case is that many of these products are copyable. Robinhood competes with Schwab, Fidelity, Interactive Brokers, Coinbase, SoFi, Cash App, Webull, and many others. These competitors all overlap with different parts of Robinhood's ecosystem. So Robinhood's moat is real, but it is not unbreakable. Now, valuation. At around $70.87 per share, Robinhood's market cap is about $65.1 billion. Using company-reported last 12 months figures, Robinhood generated about $4.6 billion of revenue, about $2.6 billion of adjusted EBITDA, about $1.9 billion of net income, and LTM diluted EPS of 2007 based on those numbers. The stock trades at about 14.1 times market cap to LTM revenue. Using around $5.2 billion of corporate cash and investments, the enterprise value to revenue multiple is about 13 times. Market cap to LTM adjusted EBITDA is around 25 times, and enterprise value to adjusted EBITDA is around 23 times. Price to LTM diluted EPS of 2007 SEX is about 34.2 times. The reported market PE from current market data is around 29.5 times. Either way, this is not a low valuation. Robinhood is being valued as a high-growth, high-margin fintech platform with significant optionality, and that valuation can be justified, but only if Robinhood continues executing. The market is basically assuming that net deposits remain strong, gold adoption keeps rising, Robinhood expands beyond trading, margin lending and credit products scale profitably, international expansion adds growth, adjusted EBITDA margins stay high, and dilution remains controlled. That is a lot of execution. The valuation becomes harder to justify if trading volumes normalize lower, crypto stays weak, product expansion increases costs without enough revenue, regulation hits key revenue lines, customer growth slows or margins compress. So my valuation view is that Robinhood looks fairly valued to slightly expensive. The business is stronger than it used to be, but the stock is not priced for disappointment. Now, Let's look at the 5-year outlook. Over the next 5 years, Robinhood's upside depends on whether it can transform from a trading-first platform into a broader financial platform with deeper wallet share. A reasonable base case is that revenue grows from roughly $4.6 billion today to around $8 billion to $9 billion in 5 years. That would imply a mid-teens annual growth rate. The growth drivers would be more funded customers, larger average account balances, higher gold penetration, retirement asset growth, margin lending growth, credit card revenue, banking deposits, advisory and managed products, international brokerage, crypto infrastructure, and AI-powered tools that improve engagement and monetization. The key question is margins. Robinhood already has very high adjusted EBITDA margins, but I would not assume margins keep expanding forever because the company is investing heavily. International expansion costs money. Banking and credit products introduce credit risk, compliance costs may rise, customer acquisition spending may increase, and new products can create operational complexity. So in a base case, I would assume long-term adjusted EBITDA margin of around 40% to 45%. That is below the recent LTM level, but still very strong. For the base case projection, let's assume Robinhood reaches $8.5 billion in revenue in 5 years. If adjusted EBITDA margin is 42%, that means adjusted EBITDA would be about $3.57 billion. If net income margin reaches roughly 28%, net income would be about $2.38 billion. Assuming diluted share count stays around 923 million, EPS would be about 2.58%. If the market applies a 35 times PE multiple because Robinhood remains a high-growth fintech, that gives a projected share price of around $90 compared with the current price of $70.87. That implies upside of about $19.13 per share, or 27%. On an annualized basis, that is roughly 4.9% per year. That is positive, but not extremely compelling for a high-risk fintech. This is why valuation matters. Even if the business performs reasonably well, the stock may not deliver amazing returns if the starting valuation is already high. Now let's look at the bull base and bear cases. In the bull case, Robinhood successfully becomes a next-generation financial super app. Revenue grows to $11 billion in 5 years. Gold adoption rises meaningfully. Net deposits stay very strong. International expansion works. Banking, retirement, advisory, credit card, and margin products scale. Crypto and tokenization recover, adjusted EBITDA margin stays around 45%. Net income margin reaches 32%. That would mean net income of about $3.52 billion. With around 923 million shares, EPS would reach about 3.81 scores. If the market applies a 40 times PE multiple due to strong growth and platform optionality, the stock could trade at around $152 per share. From $70.87, that would be upside of about $81.13, or $114.05. That is a strong upside case, and I think it is plausible if Robinhood keeps compounding deposits, increases wallet share, and proves that these newer products can become meaningful revenue streams. In the base case, Robinhood remains a strong fintech platform, but growth moderates. Revenue reaches $8.5 billion, adjusted EBITDA margin is around 42%, net income margin is around 28%, EPS reaches about 2.58. The market applies a 35 times PE multiple. That gives a projected price of around $90 per share, or 27% upside from the current price. So in the base case, the stock can work, but the return is not huge. In the bear case, Robinhood remains profitable, but growth slows and the market re-rates the stock lower. Revenue reaches only $5.8 billion in 5 years. Trading activity normalizes. Crypto remains weak. Regulatory pressure limits certain products. New initiatives add complexity without enough return. Adjusted EBITDA margin falls to 32%. Net income margin falls to 20%. That would mean net income of about $1.16 billion. If share count rises modestly to 940 million, EPS would be about 1.23. If the market applies a 22 times PE multiple, the stock would be worth around $27 per share. From $70.87, that would be downside of about $43.87 or 61.9%. And this is important. The bear case does not assume Robinhood collapses. It assumes Robinhood remains profitable, but the market stops valuing it like a high-growth compounder. That is the danger when you buy a high expectation stock. The business can still be decent, but the stock can fall a lot if growth disappoints or the valuation multiple compresses. Now, let's go through the key risks. The first risk is trading cyclicality. Robinhood still depends heavily on customer trading activity. If equity, options, crypto, or newer trading products slow, revenue can fall quickly. The second risk is crypto volatility. Crypto revenue fell 47% year-over-year in Q1, which shows how sensitive this segment still is to market cycles. The third risk is regulation. Robinhood operates in brokerage, options, crypto, banking-like products, credit, securities lending, event contracts, international markets, and AI tools. These are all heavily regulated areas. The company also faces risks around litigation, payment for order flow, event contracts, crypto products, AI, and compliance. Payment for order flow, or PFOF, is when brokers receive compensation for routing customer orders to market makers. It is an important revenue source for some brokers, but it is also a regulatory debate. The fourth risk is product complexity. Robinhood is launching many products quickly. That can drive growth, but it also creates execution risk, compliance risk, security risk, and operational risk. The fifth risk is margin and credit risk. Robinhood's margin book grew 93% year-over-year to $17 billion. That is a major growth driver, but margin lending also requires strong risk management. Credit card net interest revenue is also scaling, and credit products can be profitable, but losses matter if the credit environment worsens. The sixth risk is valuation. At roughly 13 times EV to revenue and over 20 times EV to adjusted EBITDA, Robinhood needs strong growth to justify today's stock price. The seventh risk is competition. Robinhood has a strong user experience, but it competes with major brokerage, fintech, crypto, and banking players. Many of its products can be replicated. And the eighth risk is reputation and political exposure. The Trump accounts partnership could expand Robinhood's reach, but it could also create political and reputational risk depending on how the program is perceived and executed. So what should investors watch next quarter? The first thing is net deposits. This is probably the clearest signal of customer trust and wallet share. If customers keep moving money onto Robinhood, the long-term thesis remains stronger. The second thing is Gold subscriber growth and Gold adoption. Gold is central to Robinhood's recurring revenue and deeper customer monetization. The third thing is transaction revenue take rate. It is not enough for volumes to rise. Investors need to see whether those volumes actually translate into revenue growth. The fourth thing is crypto revenue and crypto volumes. Crypto remains a major swing factor. The fifth thing is margin book growth and credit losses. Margin lending is attractive, but risk management becomes more important as the book grows. The sixth thing is operating expense discipline. Management raised 2026 adjusted operating expense and stock-based compensation guidance to $2.7 billion to $2.825 billion, including the Trump accounts investment. Investors need to watch whether this spending actually produces growth. The seventh thing is international expansion. Singapore, Indonesia, Canada crypto through WonderFi, and broader global expansion are all important to the long-term story. And the eighth thing is new product monetization. Cortex, Robinhood social strategies, banking, Gold Card, and Robinhood Ventures need to prove they can become material. So, bringing everything together, Robinhood is now a profitable, high-growth, high-margin fintech platform with a strong balance sheet and improving diversification. Q1 showed real progress in deposits, platform assets, Gold subscriptions, margin lending, and product expansion. But the quarter was not perfect. Revenue and earnings missed expectations. Crypto was weak, expenses grew faster than revenue, net margin declined, and the valuation is still demanding. So my overall view is neutral to moderately bullish. The business quality is improving, but the stock is not an obvious bargain. At today's price, Robinhood is a high-quality, high-risk growth fintech where the future return depends heavily on execution. If Robinhood successfully becomes a true financial super app, the upside can still be meaningful. But in a more normal base case, the projected upside is not huge relative to the risks. For me, the investment becomes much more attractive either at a lower entry price or with stronger evidence that non-trading revenue streams like gold, retirement, banking, advisory, credit cards, margin, and international products can scale sustainably. So the key takeaway is this: Robinhood is no longer just a speculative trading app story. It is becoming a much more serious financial platform. but the stock already reflects a lot of that optimism. And for a 5-year investor, the question is whether Robinhood can grow into that valuation fast enough to make the risk worth taking. That is what I'll be watching closely over the next few quarters.